again. Okay, so I'm starting the recording again. So the thing that boiled to the top from across the board was how do we deal with this PPP loan forgiveness application? You know, this is, if all of us who've taken a look at it, it's onerous, it's confusing, it's all these examples of Mary did this and Susie did this, and it's very confusing. So we all are, you know, kind of looking at it saying, well, how in the heck do we complete this thing? So that was the number one topic that everyone wanted to talk about, is how do we get through the process of completing this PPP loan forgiveness application? Now, since then, fortunately, legislation has been passed again, and we all have a little more time to complete this, and there's a little more flexibility. However, we still have to do this at some point. We still have to get it done. So the can's been kicked down the road a little bit, but we still have to complete the application process. So this is still an important topic for us. And unfortunately, it's not thrilling. It's not sexy by any means.
Not at all.
I mean, this is unfortunately a very boring topic. So I made some really strong coffee to try to get through this. So what we're going to ask you to do today is try to just walk us through this as best you can. And I know that since the presentation you put together previously, it's only been a couple of days since legislation has come out. What we're going to ask you to do is just walk through it with us or for us, and we'll try to hold our questions until the end, and then we'll do a little Q&A at the end. We have about an hour allotted to this. Everyone's really busy. We try to do this over lunch hour so people can sit down at their desk. And what I will do also is I will monitor the chat so that if people have chat questions, they can submit those via the chat function. And if there's something that's like a really immediate, I'll interrupt and ask the question. But for the most part, we'll try to hold to the end to have Q&A. Okay.
Hey, James, before Jan starts, I think it'd be helpful for everyone to mute their, if you're not already muted, make sure you mute, because we're going to get feedback while she's talking. So.
Yeah, that's great advice, Lauren. And again, Lauren, do you have anything you want to add before we get rolling here?
Maybe at the end, not right now.
Okay. With that having been said, I'm going to turn this over. Jan or John, I'll allow you to introduce yourselves. I will just say Shumaker Loop has been a great resource for us. This is the third time you guys, the firm has offered up expert attorneys pro bono for us, and I really appreciate you coming on board. I've known Jan for the over 20 years that I've been in Sarasota. She's worked with me on a number of transactions at Center for Sight. I'm going to allow you both to introduce yourself, talk about your credentials. Jan, should I have should I share this, turn the screen over you to share? Or can you share the screen on your own?
I'm not sure how to do that, sorry.
Do you have slides to talk through?
No, I didn't know if our PowerPoint was sent out to them in advance.
It has not been, no.
Oh, okay.
Oh,
so
yeah, it was sent out. It was sent out last week. That's true.
Okay, so we're just.
Do you want me to pull that up? I can pull that up on my screen.
Oh, okay. John was going to start out with, well, we'll introduce ourselves, and then John was going to give a synopsis of the most recent change with the Flexibility Act, and then we were going to go through generally our presentation from.
While you do that, I'll find the PowerPoint and I'll get it pulled up.
Okay, perfect. So I am Jan Pitchford. I'm in the Sarasota office of Shumaker. My area of specialty is financial institution. I have a certification with regard to SBA loans, nothing of which has anything to do with the PPP program. That's something totally new and different, but it's certainly been an interesting and exciting ride, and it's given me an opportunity to work with John Dombrowski of our Toledo office, who he can give you his credentials, but his background is in tax. So, John?
Yep. As Jan said, I pretty much stay in the tax world, do some corporate planning, so just a lot of business planning. And on top of that, I also do litigation too. So when people get notices from the IRS or state agencies looking for more money, I deal with those issues as well. But the PPP loan, once that came about, because at least with the IRS, everything was kind of put on hold for a bit. I was already looking at all the changes for the IRS, like delays in payroll taxes, et cetera. So once the PPP came out, I figured that was going to be a huge topic. I mean, free money, and who's not going to follow that program? And it's given me a chance to work with Jan as well. So thanks for having us. And with that, I will get into it. Just starting out, as everyone knows, we already said that there has been some amendments recently that were enacted and that President Trump signed into law. And they did make some fundamental changes to the programs. Just to kind of go over those before we get into how forgiveness works generally. Probably the biggest one that most people are talking about is the fact that the covered period under the original legislation, meaning the amount or after you got a loan funded, you had 8 weeks or 56 days within which you had to spend the funds for forgiveness purposes. The recent legislation changed that to 24 weeks. But important to note, it's at the option of the borrower. So if you received funding before June 5th, you have the option to use an 8-week period or a 24-week period. So some people are going to get it, they're going to be able to spend all the proceeds within the 8 weeks, and they probably want to apply for forgiveness shortly thereafter. But however, if you don't spend all the money within those 8 weeks and you need some more time to do that, you can use the 24-week period. Now, those are it's a pretty wide range. I mean, 8 or 24 weeks seems to be quite a bit. And there's a lot of, which once we get into the calculations for reduction formulas that Jan will get into, there's going to be a lot of questions that we still need answered from the SBA as to whether, say, you spend the funds within 10 weeks, can you use a 10-week period instead of 24, because maybe your full-time employee count is going to be getting decreased in the next month or so for whatever reasons. So we're still waiting on some sort of guidance on that specific question. There's also the change in was being called the 75-25 rule. Really, that rule was just saying that the amount of forgiveness that you request, no more than 25% of that can be attributed to non-payroll costs. The new guidance or the new law that came out changed that to a 60-40 split. However, they also added a cliff. So no more than 40% of the loan funds can be used for non-payroll costs. If that is the case, then you can actually lose forgiveness for the entire amount. So it's definitely something that you want to keep track of. We've been advising people, I know probably a lot of people already have some sort of spreadsheet that you've been using to keep track of all your spending. If not, you should have one. I'll be able to keep track of your payroll costs and non-payroll costs. And when you keep track of that, I would keep payroll costs separate. And when you have that total amount of payroll costs, whatever that is, divide that number by 0.6, and that'll give you the total amount of loan forgiveness that you can request based on payroll costs. There's also, which probably Jan, I won't get too much into this right now, but when it comes to the reduction formulas, they did add some other outs basically, or safe harbors for people requesting forgiveness. One, if people have been having, if you're shut down basically due to the Department of Health and Human Services, Centers for Disease Control, Occupational Safety and Health, OSHA, any of those agencies, if they shut you down or they diminished your capacity, I know like a lot of restaurants, at least in Ohio, they can't have more than 50% capacity right now. So if there's any sort of reductions related to that or any sort of downfalls related to that, that's going to be some sort of a reason that we can use for requesting full forgiveness or instead of having to deal with reduction formulas. And same thing if the loan recipient is having trouble hiring people back. So especially a lot of people right now, they're having issues, might not apply in your world, but with the unemployment getting that $600 extra a week, there's a lot of people that were reluctant to go back to work because they actually were making a bit more unemployment. So some people were having trouble hiring those individuals back. Also, when it comes to, it probably won't apply now that they've extended the covered period out to 24 weeks, but if there is any amount of the loan that is not forgiven, rather than starting to pay that loan back within 6 months of getting that decision, you have a year to start paying that back. And also They did clarify that once the covered period runs out, that you have up to 10 months to request forgiveness. There were a lot of people who were just kind of curious when you have to apply. I don't see any reason why you wouldn't apply for that immediately after, just to get that off your radar so you don't have to deal with that anymore. But at least they clarified you have up to 10 months to do that. So those are the changes that came through with the recent amendment that came through on June 5th. Now, just going through the actual, what we previously sent out, the, there we go, got the slide sheet up that I see. And if we could go to the next slide, just that has the general process there. Just generally speaking, what's going to happen is after the covered period, whether it's the 8 weeks or the 24 weeks that you choose, you're going to use the, well, I'm assuming they're going to modify the application that's currently online with the SBA. They're going to modify that application because it only refers to 8 weeks. But you'll use whatever application that they do have. You give that to the lender with all the documentation you have, so all the canceled checks, receipts, Form 9041s, everything else that you're going to need to document forgiveness. The bank will then have 60 days within which they have to make some sort of decision on forgiveness. The guidance has directed banks to work with borrowers, so if there is some sort of discrepancy with documentation or anything, the banks should be getting back in touch with you to make sure that everything's set. If there is some sort of disagreement and you just can't come to agreement with the bank will issue their decision to the SBA, and you can actually file an appeal with the SBA as well, kind of stating your side of it. The SBA will consider everything. But again, that should hopefully not be necessary. You should be able to work with your bank and be able to support all of the forgiveness questions that the bank might have before they submit that to the SBA. Just clarification though, this is especially important for, well, for anyone, but especially important for people with loans over $2 million. The current guidance has instructed that borrowers need to retain all documentation for 6 years after the date on which the loan is actually forgiven, meaning the date that the SBA gives you a decision on forgiveness. What that means is that the SBA also has up to 6 years to audit at that time too. So again, that's very important when it comes to anything over 2 million. We know that the SBA is looking at to determine whether or not borrowers could make that certification that said, due to the uncertainty of COVID, that we need these loans. There was a lot of going up through the forgiveness process until we actually had some more concrete guidance. There was a lot of issues about how someone can determine whether or not the uncertainty led to the necessity of the loan. The SBA clarified that anyone under 2 million, they're just going to deem that they made that no problems. Anyone over 2 million, they are going to have some sort of documentation on file. And we've been giving people guidance on that. So if you do have any issues on how to document whether or not you needed the money, if you had a loan that's over 2 million, I'd urge you to contact us offline just so we can help you get the documentation straight. That way, if the SBA ever does knock on your door, you do have that set and ready to go for them. If we go to the next slide, please. And that's, yeah, next one. There we go. So what will be reviewed in the audit? What I was talking about, the certification standard for borrowers over 2 million, we have that. That's the last bullet point there. But the other things that SBA could review would be the eligibility determination. We've had a few people that they had over 500 employees, so they didn't qualify under that easy standard right there. So there's other ways to qualify, that being if you're defined as a small business under SBA standards, or if you have certain thresholds for tangible net worth and net income over a 2-year period. So the SBA is reserving its right to make sure that people were eligible for the loan. If you're not determined to be eligible for the loan, then it can't be forgiven, and you're basically required to pay it back. Then also the loan amounts, the SBA says they're going to reserve the right to look at the loan amounts, the use of proceeds, forgiveness amounts, the documentation that supports that. But in all honesty, if you go through the forgiveness process with the bank, they're going to flesh out a lot of the issues for you. And even if the SBA does look at it, everything should likely be in order at that point in time. But we really think it's just the SBA reserving its right to, since this was a process that, or the whole program itself was actually put out quite quickly just due to the response to COVID and as a necessity. And there was just a lot of questions, slip-ups, ambiguities along the way. And I think the SBA is just reserving its right just to make sure that they can use it to make sure that no one that got a loan that shouldn't have gotten it got one. So if you went through the process before, you know you're eligible, you know you're spending the funds right, I wouldn't be too concerned about any sort of audits in the back end. Next slide, please. And this is what I was saying before about the appeals process. If there is some sort of negative finding, they'll contact you. See, the SBA can also contact borrowers directly rather than through the lender, but if they do contact the lender first, the lender's supposed to turn around and contact you immediately. And go to the next slide. And one more. There we go. This is more the things that most people are interested in, what counts as forgivable costs and what doesn't. Going into it, there was some ambiguity because the legislation said that forgiveness applies to costs paid and incurred during the covered period. And when it comes to accrual versus cash basis taxpayers and what that meant, no one had any clue. And there was all sorts of guesses. However, the most recent clarification on forgiveness, the forgiveness guidance, clarified that it applies to costs paid or incurred during the covered period. Paid means that the date that the paychecks are distributed or the ACH credit is initiated. Incurred means like a day that is, and we're talking payroll costs here. That means a day that the employee worked, or if they were on furlough, that they were scheduled to work. So you kind of got to look at both of those. And when we look at the covered period, if you have a bi-weekly payroll period or weekly payroll period, unfortunately this won't apply for people that have a twice a month payroll period, but if you have bi-weekly or more frequent payroll period, you can use what's called the alternative payroll period. And that begins on the first day of the payroll cycle following disbursement. So what we're telling people to do is calculate your payroll costs based on the covered period and the alternative payroll covered period. Just kind of compare to see which cycle works best for you. So with the alternative covered payroll period, that means that if, say, this Friday would be the, hold on, make sure I get my dates right. This Friday the 12th, say I got a loan today, typically my covered period would begin today on the 9th. But say I had payroll that's going out on Friday, I could instead use the 13th, which is the first day after that payroll goes out, or probably June.
I'm going to be on this call for an hour.
June 14th. We could use that as the alternative payroll covered period. So while the June 12th payroll
go out that door, go through the open door at the other end, and the first room.
So I'm going to keep talking. So while the June 12th payroll would not be included in the alternative payroll cycle, every single day after that would be included. So again, you want to make sure you want to do those calculations based on the regular covered period and the alternative covered period. And just for clarification, the alternative payroll covered period only applies for payroll costs, doesn't apply for non-payroll costs. And if you choose it, you also have to use it when it comes to measuring the FTE count and any other sort of reduction formulas that we have to consider. The guidance did clarify this was more of an issue before they changed the covered period to 24 weeks. But there was a lot of questions of whether or not you could include compensation going to furloughed employees and also bonuses, because people were getting the idea of using bonuses to kind of soak up forgiveness. The guidance still allows bonuses and hazard pay to qualify for forgiveness. But if you're using that 24-week covered period, that might not be a necessity as it was before. Self-employment income, just similar to employee compensation, it is capped at an annualized amount of $15,300, or sorry, an annualized amount of $100,000, which under the 8-week covered period was working to $15,385 total. In all honesty, I haven't ran that over the 24-week period, but that would be an increase over the 15,000 amount total. So if we go to the next slide, please. So non-payroll costs, again, the alternative covered period does not count for this, but similar to the payroll costs, any costs paid or incurred during the covered period will qualify. So say we have a borrower and the recovery period loosely stating is June and July. If they got their rent, if they got their bill for rent in June, they paid in June, but is to cover for July, they would be able to include that May rent since it was paid in June. They would also be able to include June and July, even if you pay the August bill or even if you pay the July bill in August, you could still include that July bill because it was incurred during the covered period. So again, making sure that we get all those costs that are paid or incurred. We want to make sure we include all those in there, because that's going to beef up the amount of forgiveness you can request. And just the last bullet point, that's saying all the documentation for payroll and non-payroll costs. It is currently listed on page 10 of the loan forgiveness application, but it's going to be all sorts of tax forms, bank statements, payroll reports, lease agreements, and mortgage obligations, other documents. When it comes to non-payroll costs, we have to remember that any sort of lease agreements or any sort of obligations that we had to pay under, those have to be under agreements that were entered into before February 15th, 2020. Any sort of more recent lease agreements or anything like that, unfortunately will not qualify for forgiveness. So you don't want to use those when you are running your calculations for forgiveness right now. And I believe next slide, I'll be handing this over to Jan at this point.
Thank you, John. I have to apologize in advance. My segment is very boring. I get all the examples, which when we divided this up, I didn't realize that. And I went to law school because I'm not good at math. And John is a tax attorney, so go figure. So we started the webinar a week ago based on a new IFR regarding the forgiveness guidance. And of course that changed this past Friday with the new act. But so please keep in mind that we're using information from the prior IFR. The IFR covered these issues that I don't need to read to you, but we'll go through examples of each one of these to help us in completing the forgiveness application, which, by the way, is going to be amended, and it'll be an entirely new form with the new direction that we just received. Next slide, please. So just to summarize for everybody, I know you guys are all very familiar with this, but there are 3 tests in determining the reductions in the forgiveness amount. The first one obviously changed. We don't have the 75-25 any longer. It's the 60 for the payroll, which John went over earlier. The next has to do with reductions in FTEs, which is the full-time equivalent employees, and that you work out the ratio and then work your reduction from that ratio. The third is a compensation reduction, and has to do with a decrease in wages for those employees making less than 100,000 on an annualized basis. Next slide. So jumping right in, the first example that we were given, it was this IFR gave us new information, and it had to do with the fact that you have laid off employees. So if you have these laid off employees, you can get an exemption provided that as a borrower, they were laid off or reduced during the forgiveness cover period or the alternative payroll cover period that John had discussed. If the applicant or borrower had made a good faith attempt to rehire or restore the hours at the same salary or wages that they worked prior to the last pay period. And if the employee and the former employee rejected that offer, then the employer could exclude that person from their calculations of the FTEs. That's again the full-time equivalents. But it was made very clear that you could only exclude them if the borrower, one, maintains records of the layoff or reduction, has the good faith written offer in writing, and in writing the employee's rejection. And secondly, the borrower must then inform the state unemployment insurance office of the employee's rejection of the offer within 30 days of the rejection of the offer. And that process is supposedly detailed in greater gives greater information on the SBA website, which we have on the PowerPoint there. So our recommendation is to be sure that you document each layoff or each reduction in the hours, make sure it's in writing and keep a copy, and have evidence that it was delivered and received, and somehow document that they rejected the offer, hopefully by a signed writing, but if not, maybe by an email or a text message. It's all, very important to document. The effect of reduction, this is the second test we talked about, a reduction in the full-time equivalent employees. A reduction in your full-time equivalent employees during the forgiveness cover period, you compare that to the number of the full-time equivalent employees during the selected period, which the borrower gets to pick. It's either going to be that February 15th to June 30th date, or the January 1st to February 29th of 2020. The other was from 2019. Or there are, and this doesn't apply to you, seasonal employers have a different option as well. So you compare those two, and that is what results in a reduction in the forgiveness amount based upon that FTE reduction. So they gave an example, and the example that they gave was when the FTEs during the chosen period was 10, and they were reduced down to 8 during the covered period. And so that reduction is 20%. Therefore, an equal reduction in the forgiveness amount must be applied. Now, we'll talk about later about the ability to restore your FTEs. Used to be prior to this recent act, no later than June 30th, but now we have December 31st. Next slide, please. So in order to understand how to apply that reduction, you have to know what their definition of an FTE is. So their definition of an FTE is an employee who works 40 hours or more on average each week for the borrower. The hours of employees who work less than 40 hours are calculated as proportions of a single full-time equivalent employee and then aggregated. Next slide, sorry. So if an employee works more than 40 hours each week, it's still that employee is still considered to be an FTE employee of only 1. But an FTE who's paid for less than 40 hours per week is determined in one of 2 ways. Next slide, please. So the first method, the average number of hours paid per each week by the borrower to each employee is divided by 40, with an employee working an average of 40 hours or more per week being counted as 1 FTE. And then those under 40 hours being a percentage of 40 hours, which, like if they worked average of 30 hours per week, you divide that by 40, that would be 0.75 FTE. There's another method that they came up with in this, this rule, that for administrative convenience, they decided that a borrower can choose to have their FTE count work as a half a FTE for any employee who works less than an average of 40 hours per week. That is particularly useful for those small borrowers who don't keep records of actual hours worked. So only one method can be elected, and you must use it consistently for all of the chosen reference periods. Next slide. So the third test has to do with a reduction in salary or wages. A borrower must reduce the total forgiveness amount with respect to any employee hired in 2020 or any employee who was not paid more than the annualized equivalent salary or wages of $100,000 during any pay period in 2019 if the employee's salary or wages were reduced by more than 25% during the covered period. As compared to the reference period, again, being chosen by the borrower, either that January 1st to February 29th period or the February date. The reduction is only on the amount in excess of 25%, and the calculation must be done for each employee, which is arduous, each employee on an individual basis. So one of the examples they gave was where you had an employee's weekly salary during the reference period as $1,000, and then it was reduced to $700 per week during that applicable covered period. So that reduction would exceed the 25%. The first $250 of that reduction, which is the 1,000 by the 25% is excluded from the calculation because that was at the threshold. So the forgiveness amount would be reduced by the $50 per week for the 8-week cover period. Obviously, we need to change that now to the 24 covered period. For in that example, the total was $400. One of the things that we did notice in the language of that forgiveness IFR, they don't make it entirely clear, but it would seem that a borrower can exclude any employee who during any single pay period in 2019 was paid a salary or wages in excess of $100,000 annualized. So that is something, it's possible to eliminate a significant number of employees from the calculation, even if over the entire 2019 year, the employee earned less than $100,000 in the aggregate, if during any single pay period in 2019, they did receive in excess of $100,000 annualized. Next slide, please. So what do you do? How do you account for a reduction based on a reduction in the number of employees as relative to the reduction relative to salary and wages? So basically, how do you take test number 2 vis-a-vis test number 3? And so in order not to double penalize, the salary wage reduction is calculated before the FTE calculation. In this way, that salary wage reduction applies only to the portion of the decline in the employee's salary and wages not attributable to the FTE reduction. The approach is evident in this, in the way that reductions are calculated on the application. They give the example in which you have a full-time employee's hours, so the FTE is 1, and it's reduced to 20 hours per week. So now it's an FTE of 0.5, and the employee's hourly wage remained the same. In that situation, the reduction's attributable only to the FTE reduction, so there would be no wage reduction taken on the forgiveness amount. Again, the salary wage reduction only applies to the portion of the decline in salary and wages not attributable to the FTE reduction. And we've used this language to take, for example, we've been asked about overtime. For instance, if you had an employee that before the pandemic was receiving a lot of overtime, and then after, during the covered period, they were working just regular hours. So when you compare those two figures, you have a lesser amount. The wage or the salary was not reduced. It was just a difference in the overtime. We don't think that you need to reduce the forgiveness amount based on that difference in hours because it's not due to a salary change or wage reduction. Next slide, please. Restoring reductions or salaries or FTE numbers no later than, it's June 30th. Well, that's been changed, obviously, to December 30th of 2020. A borrower who reduces an employee's salary wage count between February 15th and April 26th, this is called the safe harbor period. And there's going to be more guidance on this now with the new dates. Or if you laid off or reduced your FTE during that period, you can avoid the reduction in the forgiveness amount by restoring the salary or wage or rehiring or increasing the hours of all FTEs to the levels of the safe harbor period before the new December date. This clarifies that it doesn't change the effect or the requirement of, at least at the time, it was the 75%, but again, the 60% of the loan forgiveness amount must be still attributable to the payroll costs, even though you can restore these numbers before the end of the year. Next slide, please. As stated in the forgiveness application, a borrower can also exclude from the FTE reduction any employee who was fired for cause, voluntarily resigned, or voluntarily requested and received a reduction of their hours, but only if the position was not filled by a new employee. Of course, the borrower should appropriately document the incident to support the exclusion. Again, we were hoping that the IFR at that time would have changed the 75% requirement for payroll. It did not. So in the next slide, you'll see we just talked about that the 75% still applies, which now is the 60%. And at the time, we were making sure that everyone looked at 3 different ways to analyze the forgiveness amount. It would have been, at the time, using the 75%, the aggregate payroll and non-payroll costs reduced by a reduction in wages, a reduction in the FTEs, or both. It's the lesser of these, or the aggregate PPP loan amount, or the aggregate eligible payroll costs divided by what would be 0.60 now. So that is pretty much a summary of the changes from the forgiveness IFR. We would love to open up to questions. I'm sure there are quite a few. And again, I apologize, that is the driest topic known to man. So if I haven't put you to sleep, I'm very grateful. So.
Okay, Jan, I'm going to stop sharing my screen so that I can get the slideshow off. Okay, so let me start by unmuting everybody once I navigate to that.
Then it was
Okay, so everyone, I'm unmuting everyone.
about 15.
So if you don't have a question and you have noise in the background, go ahead and mute yourself.
Not to worry, but let me hand you, because you, Mary, it doesn't much matter what you do.
That person. So everyone is now unmuted. So if you have noise in the background, go ahead and mute yourself. But I've unmuted everyone. So if you have questions, I mean, it was a great overview. I do have to say that I'm impressed that every single person actually stayed on the call the entire time. We didn't have anyone leave. I was riveted.
There you were.
It's great stuff. I was tempted to walk away a few times. I did have to take a text from my son who wanted me to take him to baseball. But anyway, so anyone have any questions for Jan or John? That was a very thorough overview. So just fire away if you have any questions, please. Got one chat question. Let's see what it says. Vince said, yes, please.
All right, Jane, sorry, Vince here. I've got a quick question in regards to the term and time. Now, they changed it from 8 weeks to 24 weeks. In the verbiage, is it now changing anywhere from 8 to 24 weeks? Or can you apply for either 8 weeks or 24 weeks? And here is my question. Looking at our expenses and running up, we do have a little bit of a buffer still left in our loan, which we want to utilize. And that's why I want to get clarity. If it is an 8 to 24 weeks, it would be easy to consume. If it's an 8 or 24 weeks, we would like to opt for the 8 weeks, but then we have to make some changes. Can you give us some clarity on that verbiage, please?
It's the latter. It's 8 or 24 weeks. We're still waiting on guidance as to how someone in your situation that kind of wants something in the middle would handle that. But as of right now, based on the amendment, it's 8 or 24 weeks.
So John, you're saying it's one or the other. There's no in between?
Correct. Yeah, one or the other, no in between right now. Now, I would expect that hopefully the SBA recognizes how far apart those are, and there is some sort of slide rule in there. But as of right now, I would not. You can't bank on that.
John, when do you expect the new application to be up and ready on the website?
That's a tough one. I mean, it should be, because I'm sorry, I'm looking at my calendar thinking too, because we're already a few months into it. People are already up to that 8-week period, so I'm not sure why the delay. Unfortunately, the SBA, the way they've been doing this whole program, they don't really announce anything that's coming down the pipe. They just put it on their website, and then all of a sudden it's up and active. They've done the applications, they've done every single piece of guidance. The only thing that we knew that was coming was the amendments, because it was talked about in the news so much. Everything else was unfortunately just kind of been tossed out without any sort of knowledge beforehand. So I know at least for me, if you were to Google Treasury Paycheck Protection Program, the first page it pops up, the Department of Treasury has a list of every single guidance it's published. And right there, that's kind of where they update. And myself, I have that up every day and I just refresh it just to see what they pop up new every day. But yeah, well, there should be something within that application. I did check actually before this call. The application itself hasn't updated. I was hoping that there would be something about that 8 or 24-week issue, but there's unfortunately nothing in there right now.
But James, when it comes out, when I get it, as soon as I get it, I'll send it to you so you can send it to the group.
I got a question from Eric. He says, if you pick the later, which is 24 weeks, can you file for forgiveness at any time, or do you still have to wait until the end of the 24-week period?
Jan, if you have anything saying that, but I would say you'd have to wait till after the 24-week period because the costs, like the reduction formulas that Jan was discussing, that's all based on the average FTE count over the covered period. So if it is a 24-week period, you're not going to know the average until the end of the 24 weeks.
Right. I agree.
Sabrina, you're indicating you have a question. Can you go ahead and ask it, or have we addressed it?
Oh, I'm sorry. Yeah, can you hear me? Sorry.
Yeah. Yes.
So initially they had said 2 months and then they went to 8 weeks. And we do our payroll on the 15th and the last day of the month. So we got our money the very last day of April. So we would be doing all of May and all of June, and our last payroll will be short 4 days. How would that affect us?
Well, if I'm understanding, so if you got funded on the day that you sent payroll out, is that correct?
Right.
So I mean, you would include that entire amount in there because it was paid during the covered period. Even though it's attributable to work that is done before the covered period, the fact that it's paid during the covered period, that means it counts. Now when we're on the back end of the covered period, 56, the 56-day covered period. If there's any sort of work that's done, say in days 50 through 56, that just haven't been paid yet or won't be paid during the covered period, as long as it's paid on the next payroll cycle, then you can include the amount paid for days 50 through 56 on and within the application for forgiveness. Now you wouldn't be able to include the entire last payroll if it's for days outside the covered period, but anything that's attributable to the covered period.
So even though yeah, because obviously we had to make cutbacks because we didn't know what day we would get our PPP, and it came the very last day of April, when of course I'd already run the payroll, and then so then we can't use that in May. We'll have to use the payroll before, because we did shorten our payroll because we didn't know if we would get it at all.
I think I'm misunderstanding the question. That what do you mean you shortened the payroll?
So because we weren't sure we would get it at all, we reduced employees. And as soon as we got it, we brought people back immediately. Mm-hmm. Because, I'm sorry. Do you understand what I mean? So that was a much smaller payroll in April than for the ones in May.
Sabrina, may I weigh in here because I think we're sitting in the same situation. So
okay.
No, we had no timeline knowing when the application will be paid out or if at all it will be paid out.
Correct.
So we had the same scenario. We ran our payroll not knowing that the money is coming. And we also received our funds on the same day that our payroll went out of our bank account. Now, up until that time, actually, payroll went out 5 o'clock in the morning. We received the funds 2 o'clock in the afternoon. So it did receive later, but time date stamp wise, we received it on the same day. Now, there's no way that we could have made any changes to our payrolls because payroll for us is run 2 weeks, and we actually process the payroll 3 days after the end of those 2 weeks, and that payroll basically gets paid out 6 days after the end of the payroll time. So payroll runs Monday to Sunday. The following Tuesday we process. The following Thursday we pay out. So we had no idea that funds were coming at all. On the Thursday, we ran our payroll, and it just so happened that on that Thursday, we got the funds. So what we
Correct.
did is we moved our payroll date or our timing date, our 8-week spectrum, to 1 day after the day that we received the funds. So we ran
Yes,
everything
so I'm
from there.
asking, are you allowed to do that?
Synchronizes us.
Yep.
And
It sounds like you're using
that's
the
what we're trying to
alternative
figure out.
payroll period. I mean, it's a choice between the covered period that would begin on the date of funding when you sent out that payroll and you got the funds in, or in this case, it'd be the very next day would be the alternative payroll period.
So you're allowed to do that. You could use the May 1st instead.
Well, before we go there, I guess I should actually backtrack. Did you say you paid bi-weekly or bi-monthly?
We pay twice a month on the 15th and the
Okay.
last day of the month.
I apologize. We can't use the alternative payroll period because it only applies for bi-weekly or more frequent. Bi-weekly is going to mean 26 payroll periods over the year, whereas bi-monthly is usually 24. So unfortunately, you're going to be stuck using the covered period that begins on the date of funding. So whatever was sent out that day, that's the amount that we got to include.
Okay. Thank you. And then, so the other one,
Mhm.
through the period, will only can calculate part of that payroll. We can't use that whole one since
On the
it'll,
back end,
yeah,
yeah, it'd only be whatever is attributable to the amount during the covered period. But as long as it's paid
Okay.
on it doesn't have to be paid during the covered period, as long as it's just paid on the next payroll cycle after that.
okay. Thank you.
You're welcome.
Thank you.
Michelle has a question for us, which is, her question is, can it be 90% payroll and 10% rent/utilities?
It can.
Yes.
Be 100% if you want.
Yeah, it could be, yeah.
And I had a question for those of us who are procrastinators and like to have a hard date on our calendar, like April 15th as tax day.
Except
If
this
you
year.
do the 8-week or you do the 24-month or or the 24 weeks, what's the final date when you have to have the application submitted?
It is within 10 months of the cover period, which is extended to the 24 weeks under the new bill. So
Or-
10, well, I'm sorry, go ahead.
As I say, it's also, just to clarify, it's the earlier of either the 24 weeks or if there's by chance someone that's just getting a loan here, December 31st, 2020, in case you get a loan later in the year for some reason.
So the earlier of.
But that's when the covered period ends. And then like what Jan was saying is after that covered period ends, you have 10 months within which you have to apply for forgiveness.
Okay. Vince, you have a question about utilities?
Yeah, sorry, looks like I'm talking a lot here. Question on utilities. From what I understand, we can include telephone costs, internet costs. Can you give us a little bit of limitation in that regard, especially when it comes to, is it just internet services provider? Is it just phone line provider, or does it include hardware cost, as in a phone system? What is the limitations on utilities?
It's for the service, for the distribution or service. So I wouldn't include any sort of hardware costs. Now it's going to be a tricky one because cell phones, I mean, you have the internet, it's used for the internet and the phone. I know there's some plans, I don't even know if I have them, but that you can actually include like a part of the bill is going to be for the hardware over the course of time. Whether or not I can include that, I think the bank would probably make the final decision on that. But anything, it has to be for a service, not any sort of like hardware or any sort of capital equipment. Unless, I mean, that's a separate category of cost if you get a loan for capital equipment and the interest they can claim. But just when we're talking about utilities, it has to be for the distribution of some sort of service. So like a telephone service, an internet service, that type of thing.
That's a common question.
Yeah, I'm getting that one a lot.
So guys, it's 12:54. I think we probably ought to try to wrap up. If you have follow-up questions you want to send to me that I can forward on to Jan or John, please do so. Or you can find either of them on Shumaker.com. That's SHUMAKER.com. And again, I want to say I appreciate them coming on and doing this pro bono for us and the entire firm of Shumaker, Luke, Kendrick. This is the third webinar they've done for us with various attorneys. So I really appreciate what they're doing. Lauren, I know you said you wanted to say something toward the end. Are you there?
I am. Oh, you want me to talk? Well, this is our last Zoom call for this month. We'll be doing another one next month. If you have ideas of topics that you want to be discussing, please email James or myself. And in regards to SBH sponsoring these, all I ask is that when I do reach out to you, because I won't do an infomercial now, just take the time to read what I send. You guys are all pretty good about doing that anyway. Everybody welcomes me into their offices. But that's it. Hope these Zoom calls have been helpful.
And Lauren, we are going to do these now the first Tuesday of every month. Is
right.
that correct?
Yes, that's correct.
Fantastic. Thank you all for joining us. Jan, again, thank you. John, I appreciate it so much. And Lauren, thank you for all your hard work in putting this together.
And to you, James, as always.
Thank you.
Don't forget yourself.
Thank you.
Bye.
Bye-bye.
Thank you.